All right, thank you. Oh, God, I always get this wrong one. I see that quite a few of you have already started taking your reading week. Class is kind of empty. Good, I hope they're enjoying the ski slopes. Got a couple of announcements which I need to make, admin stuff. And for those of you who are not there, bad luck. I am arranging, as I said, some workshops in international project finance. There will be in the first couple of weeks in March. What I'd like to ask you to do, those of you who are interested in attending, to please send an email to our Pathways Secretary. You know who that is, right? You don't know the Pathways Secretaries. Do you want to just tell them your name at least, now that they are interested? It's Sira.
Yes.
Okay. Send an email, please, and say you'd like to attend. The reason I'm asking for this is very simple. The only lecture room we've got accommodates only 100. So we're going to have to operate on the basis of selecting 100 people, assuming we get so many people interested in attending project finance. I doubt it, but anyway, let's wait and see, okay? But please give your names and I'll take it from there. Second thing, I know so many people are ill, just like I was, but the easiest thing to do is just send me an email and say, sorry, I'm ill, I can't attend the seminars, could you please assign an alternative seminar? And not run in with a mask and tell me I'm ill, I can't come, because you probably infect about 6 people by then. So just send me an email, okay? That's all that's required. I will reassign on that basis, okay? Third one is a bit more serious. I think I put a notification on Keats, and I hope you all read it, and if you haven't, please read it. And I thought I'd mention this because it appears that some of you are trying to organize Facebook groups for the exam. Now, there's no problem at all with Facebook groups to do seminars, to discuss seminar issues, or whatever. But what you can't do is to do a Facebook group during the exam hours. You cannot do it. You can, in other words, you're going to rely on somebody who's good, and you're going to get his or her or its analysis, and you're going to try and use it. That, unfortunately, is plagiarism. You can't do it. And if you hope to do it, I thought I'd warn you that there is an exams division algorithm which picks it up. Some people were picked up last year doing it, and the result is penalties. And the penalties may include failure of the LLM, okay? So please don't do it. Whatever discussions you want to have on Facebooks, please do it before exam date, okay? And after that, shut down because you're supposed to do the exam on your own. The person being graded is you, not the best guy in your Facebook group, okay? So let's try and do it the way it ought to be done. Are we clear? Good, great. I had quite a few emails about pari passu clauses. Now, I don't think everybody here is interested in pari passu clauses and how they operate. So what I'd like to, I know you wanted to talk about it at lectures. What I suggest is that we raise it at seminars. Does that work for you? Or would you like me to talk about them at lectures? Who's interested in pari passu clauses anyway? 1, 2, 3 out of 180. Well, can we do that at seminars in that case, please? Because I think a couple of you have read something that I think was written by Philip Wood about pari passu clauses, challenging the decision of the US court in the Elliott Capital ruling on the basis that it analyzes the clause without having regard to the purpose of the clause. My answer is very straightforward. It's common law, remember? You don't start looking for purpose, philosophy behind it. What is exactly written in the bond or the loan? That's the clause that you need to analyze, not what's the purpose, what happened in the 19th century, and what was the history of this clause. It ought to be interpreted in accordance with that history and philosophy, blah, 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 irrelevant. That's exactly what the New York court said. What's the clause? We look at the language, and the analysis is as follows. Interestingly, for those of you who are interested in these things, there's a Belgian court ruling in the Elliott Capital case, which follows exactly what the New York court said. So, if you want to follow it up, please do. But if you want to discuss it further, I'd rather not spend time today. Maybe if there's time at the end of the class, I might. Please follow it up at the seminars. We can discuss it in detail. I got no problem with it. Okay. Right. Okay. So last week, we were talking about United States regulation. How many of you actually followed the structure that we were trying to get through? Or how many of you are having difficulties in understanding it? It is complex, and I appreciate that the lecture was dense. There was a lot of material for you to understand, and it is quite technically complex because of the way US regulation is drafted. But I think if excuse me, if you can walk away with a few bullet points and then go back and do the reading in detail, I think that might help. The key bullet points that I would draw to your attention is as follows. One, that US securities laws are applied extraterritorially. Point one, by the courts and by, far more importantly, the Securities and Exchange Commission. Consequently, whether you're doing a bond issue in London, Frankfurt, Singapore, Hong Kong, to investors even not even to investors in the US but outside the US. United States securities laws must be complied with. Stop. Now, there are hundreds of cases trying to work out the circumstances in which US securities laws may not apply to extraterritorially on the basis of whether or not there is substantial effects in the US or substantial conduct in the US. In practice, nobody is going to worry about arguing about whether or not there's substantial conduct in the US or substantial effect in the US during the course of a bond issue, share issue, or other securities issue. That's not how this world works in practice. If people make a mistake, you end up in court, you're hauled up by the SEC, then you can argue the point. But that's not the way the global markets work. That's not where global market players want to end up, with the SEC's injunctions, with fines and court litigation. Absolutely not. Consequently, the way forward has always been to have a set of parameters which, if complied with, results in the disapplication of the main points of United States securities law which would otherwise need to be complied with. The most important of which is the Section 5 registration requirement, namely that before any securities issue is done anywhere, must comply with Section 5 of the Securities Act. Otherwise you face sanctions, fines, etc., etc. Now clearly, global markets cannot operate with compliance with the Section 5 requirements of filing registration statements, etc. Consequently, these exceptions matter very importantly in these markets. The exceptions under which the global markets operate are twofold. One is Regulation S, enacted in 1990, and the other is Rule 144A, also enacted in 1990. They enable two things to be done. Regulation S enables securities issues targeted to investors outside the US, repeat, outside the US, to be done without compliance with United States securities laws, provided certain conditions are met. Rule 144A permits sales of unregistered securities into the US, into the hands of US investors, provided, once again, certain conditions are met. It is the basis of the global markets, the use of these two safe harbors or exceptions, and that's fundamentally your understanding. Because of that factor, i.e. that we operate within these two safe harbor parameters, in practice what is developed is that international bond issues are done on a two-tranche basis. One tranche, the Regulation S tranche, issued to investors outside the US, and the Rule 144A tranche for purposes of issuing the bonds into the hands of US investors. That's your starting point. Now, you then need to ask yourself, well, what do you need to comply with to come within these two safe harbors? Regulation S has two basic requirements which everybody needs to comply with. The no directed selling efforts, and secondly, that all buy orders must come from outside the US. The no directed selling efforts in a modern context now means all your electronic advertising about and publicity regarding the bond issue must be controlled such that excuse me, US investors cannot have access to the website and the information contained in the website on that bond issue or securities issue. Yes, you can't have radio ads, television ads. I mean, nobody does that anymore. Today, it's all done electronically, as you know. So the key one, a key component of the requirement is no advertising, no electronic websites which give publicity to the issue to be able to be accessed by US investors. And how do you achieve that? Well, the SEC, as I said, has given guidance on how that can be achieved by requiring certification of anybody accessing the website by certifying who they are, where they're from, are they in the US or not. Secondly, the buy order is coming from outside the US. It's a bit more easy to monitor because if the buy order is coming from any place in the US, well, you cannot comply. You need to reject that offer to buy. Easily done. And then you need to understand that there are additional conditions that are applicable if the issuer falls within two categories of issuers. It doesn't need to comply with any additional requirements if the issuer is a non-US issuer, a foreign issuer, with no substantial US market interest in its securities, no SASME. And as you know, as you remember, foreign issuer means A, that the entity in question, the corporate entity, is incorporated outside the US. But that's not enough. An entity incorporated outside the US could nevertheless be regarded as a US issuer and not a foreign issuer if one or more of those tests that the SEC has laid down in Regulation S are satisfied. For example, if the board of directors meets in the US, or the majority of shareholders in the US, you will not be regarded as a foreign issuer with no SASME. So that's your starting point. What kind of issuer are you? Then you've got to get into this business about, is there substantial US market interest in your securities? And this time you're looking at, if you're looking at debt securities, there's a test for debt securities as to what is and what is not set of factors which result in there being US market interest in your securities. That's a test of who has bought your securities in the past, who is the holder of record of your securities. And secondly, the important thing to remember with regard to SASME is that if it's a hybrid security, meaning not a pure debt security like an international bond, but a hybrid security like a convertible, which has got an equity element. I know we haven't done it in detail. I only mentioned it a couple of weeks ago. If it's a convertible bond, convertible into the underlying equity securities of the issuer, that has to satisfy both the test for SASME for debt and secondly, the test for equity securities. Both have to be satisfied before someone can say, I am a foreign issuer where there's no market interest in my securities. So that's your technique, pathway to saying I'm a foreign issuer with no substantial US market interest in my securities. Therefore, all I need to do is to comply with the two basic requirements in Regulation S. No directed selling efforts, buy orders from outside. That's it, you're done. If you fall outside that, you have a built-in safe harbor as an issuer of bonds or convertibles, namely the second category, issue of debt securities. Now there, an issuer falling within category 2 has got to comply with two additional requirements in addition to the first two, and that's contractual restrictions and transactional restrictions. These involve ensuring that no sales are made to US persons as defined for 40 days, essentially. And that requires A, certain notifications to be given under contractual documentation and contractual obligations. And secondly, that in effect, quite apart from there being contractual obligation, no sales being made for 40 days after closing date to anyone classified as a US person. Okay, so those are the basic parameters. Now, having said that, there is a third category of issuers who, frankly, are rarely a category which would be relevant to the global markets. They are a category who will be subject to what is known as a hard lockup, meaning that on closing date, neither a permanent global bond nor definitives, if definitives are being used, can be issued. Only a temporary global bond can be issued, and for 40 days, the bonds that have been sold can only be held in that form. And that's only at the end of 40 days that either the definitives or a permanent global bond can be issued. And that can happen only if and when the clearance systems provide a certification that all securities held on their electronic books are held for non-US persons as defined. From this, you would appreciate that, excuse me, much of the thrust of this whole regulation is to somehow shut out the ability of markets to access US investors under Regulation S. That can only be done under Rule 144A. But this, sorry, the story doesn't stop there, because even even if you are a Category 1 or Category 2 issuer, and therefore you will not be caught by Regulation S hard lockup requiring issue of only a temporary global bond for 40 days. Something else has an impact on the way international bond issues are structured, and that is US tax regulation under the Tax Equity and Fiscal Responsibility Act, or TEFRA. In particular, the deregulations, TEFRA deregulations. They require that if an issuer of bonds is subject to US tax jurisdiction, and many a global multinational corporate entity, bank, other type of issuer, ends up being caught by US tax jurisdiction, because US tax jurisdiction is also extraterritorial, and any kind of activity which enables the US tax authority to say, yes, we can tax you, gets you into US tax jurisdiction. The moment you get caught by US tax jurisdiction, TEFRA D kicks in. TEFRA D says, well, if you're subject to US tax jurisdiction, you must have a hard lockup in relation to your securities issues, which are issued in quote-unquote bearer form. And that means every international bond, every convertible bond, every medium-term note program of an issuer subject to US tax jurisdiction must comply with a hard lockup, not for securities law purposes, but for tax law purposes. And if you don't comply, you get hit with some seriously massive tax penalties. So those are the parameters of Regulation S. 144A now enables you to sell to investors in the US. It's not everybody that you can sell to. You're entitled to sell only to qualified institutional buyers. That's it, QIBs as defined. Essentially, entities, banks, fund managers investing in more than 100 million in securities in any 1 year. Essentially, that's the bottom line definition of a qualified institutional buyer. Now, the restriction in 144, sorry, the authorization in 144A to sell securities to unregistered securities to institutional investors called qualified institutional buyers in the US is, however, restricted to a 1-year period, meaning that the securities must be held by the buyer for a year, 1 year, and cannot be resold unless the resale is also to a qualified institutional buyer. Consequently, what the markets have done is to have developed a system which enables trading in 144A securities very freely. And that system is the portal system, PORTAL, of NASDAQ, which is available for membership only to qualified institutional buyers. So you get an account just like in Euroclear, become a member of Portal, and securities will be sold to qualified institutional buyers who can on-sell and trade freely if you're a member of Portal. No longer caught by the 1-year holding requirement, i.e. cannot sell for 1 year. So that's how this whole thing has been worked through in terms of the way the global markets can operate. One last thing before we move on. Excuse me. The definition of US person. Highly relevant for sales to entities outside the US. Regulation S. formula. There's a huge exception for US institutions which have foreign offices, whether banks, insurance companies, fund managers, and others who are US incorporated entities, but who are located outside the US. The US person definition for purposes of Regulation S excludes such entities. So an office of an insurance company, of a US insurance company in Frankfurt, is not a US person for purposes of Regulation S, and therefore sales can be made to them within the parameters of Regulation S. It's a hugely important exception to who is an US person for purposes of Regulation S. Now that's broadly a summary, a very brief summary about the parameters of working with United States securities laws. And in practice, what you'd expect is that in every international bond issue, there is a US legal opinion. I'll come to in detail about what must be in that opinion. But there is an opinion stating what the parameters are in respect of which that you can operate in relation to an issue. So if you haven't got any further questions, I'm going to move on to something else. By the way, before I move on, I hope you appreciate that for Rule 144A purposes, although we have said, okay, all you can do is to sell to qualified institutional buyers under Rule 144A, that's a simplification, a broad brush simplification for purposes of the markets. The technical rule is that Rule 144A is a resale safe harbor. It covers only resales of securities into the hands of qualified institutional buyers. The first sale, therefore, has got to be covered by some other exception in order not to breach United States securities laws. And I think we talked about whether or not you can use a Regulation S safe harbor for the first sale followed by a Rule 144A sale to qualified institutional buyers, and we concluded you can't because of the 40-day restriction. Consequently, in practice, what is used is a private placement exception in Section 4.2 of the Securities Act 1933. And for that, you need to ensure that there is no activity in that transaction which could be classified as any activity which is one which will take the offering into the realm of a public offer. And the parameters of how you achieve no public offer is to be found in a large number of opinions of US law firms, but more importantly, those criteria are actually set out in a regulation of the SEC, Regulation D. It doesn't say you've got to comply with Regulation D. It simply has got criteria which, if you comply, it will be regarded as an issue or offering of securities which does not involve a public offer. So that's really how the whole thing works in practice. Yeah.
Sorry, those requirements that you just mentioned.
I'm sorry?
And those requirements that you just mentioned regarding the private placement in Section 4.2, where are they located, those requirements? Because you said it was just in the opinion of the law firms.
Regulation D. I'll try and see whether I can locate this. Reg D. Regulation D sets out the parameters under which one can conclude that there is no public offering for purposes of falling within Section 4.2 of the Securities Act 1933. And I think I made the point, something important to remember, that one should not approach Regulation D on the basis that what one is doing in the markets is a Regulation D offering. You're simply using the criteria found in Regulation D. If it's a reason is, if it's a Regulation D offering under 4.2, it's caught by a 1-year resale restriction. And there's one of those glitches in United States securities laws. That 1-year restriction applicable to a Regulation D offering is not lifted by Rule 144A. That's why one has to be careful not to classify it as a Regulation D offering. Because they are called restricted securities and cannot be resold. Right, are we, yeah, oh sorry, you had a question.
I understand that the security brokers that dealers cannot specifically discuss the particular securities issued under.
Yep.
Just what if they do that? Is there any negative consequence to the issue?
Well, the issuer is not going to be affected by what a broker or dealer does, but it's simply something that one has to remember, because don't forget, every major global corporate entity has a whole number of securities dealers who will report on what they're doing, what's happening. There's constant discussions before a research report, as it's called, is published in relation to an issue or its securities. Now, if a research report of such a dealer is produced just prior to an offering, not saying this issue is fantastic and it's got amazing prospects, but actually recommending those securities which are on offer, there will be a problem for the issuer. But the real problem is for the dealer, because they would have breached the 1934 Securities Exchange Act by doing it. Sorry?
Will this situation affect the category of the issuer? For example, if the issuer is determined as
Absolutely, because if the SEC is prepared to take the view that the publication of a research report by what we call an in-house broker-dealer, meaning someone who permanently is publishing reports about a particular corporate entity, which is the issuer, that may, in the SEC's view, have the consequence that it will regard this as advertising, breaching the no directed selling efforts requirement. Now, you can go debate that point in court, but that is not the point. Your securities issue would have been derailed by now with an SEC injunction. Okay, moving on. Yeah.
The bonds under the tranche of Regulation S, do they, after those 40 days are gone, do they then?
They can be resold into the US. Yeah. I mean, the whole structure sometimes when you look at it doesn't make a lot of sense. The original reasoning for this structure was that United States regulators, the SEC in particular, was unhappy that the markets had shifted out to London. And the regulatory authority for the international bond issues was not the SEC anymore, but was the London Stock Exchange. And in the 80s and 90s, the London Stock Exchange rules were, compared to the SEC requirements under Section 5, pretty relaxed. Light touch regulation, as they called it. And so there was a refusal to allow an authorization at this end of the market, whether it's Frankfurt, London, or Paris, it doesn't matter, for securities permitted to be issued and traded under the rules promulgated at this end of the pond, to be enabled, to enable the securities issuer to sell those securities authorized and approved at this end of the pond to be sold on the other side. That was the political battle that went on. And the compromise was this, saying, okay, we'll separate the world into two. Regulation S will control one part of the world outside the US, and 144A will control what's happening in the US. That's really what came out of it. But it was essentially the idea that securities issues, and in particular the prospectus, which is the one that regulates what information is given by the issuer to the markets. The SEC always felt that the requirements at this end of the pond, by the way, I'm sorry, I shouldn't use the word pond because some of you are looking at me, what pond? The Atlantic Ocean. At this end of the pond, were not sufficiently rigorous. And consequently, such securities should not be permitted to be sold into the US where stricter standards applied. That was the basic logic of it. Now, if you think about it, under present rules, what you've got is a prospectus being produced under EU regulations. If the bonds are to be listed, as they must be, on a European Union exchange because of European Union regulations. So it'll be listed in London or Frankfurt or Luxembourg or wherever it is. So there is now a prospectus in place in relation to the securities to be issued. But that is insufficient to satisfy the requirements of Section 5, essentially. There's no requirement of recognition by US regulators and US law of a prospectus authorized under the regulations of the EU. It's as simple as that. I.e., you can do what you want with your EU regulated stuff, don't bring it in here. Our standards are higher, is essentially the message. To compromise, you've got Rule 144A. Okay, you can issue these securities into the hands of entities whom we consider to be able to handle securities which are not cleansed, sanctified by the approval of the Securities and Exchange Commission. So that's basically, if you want to put it in a slightly more political format, that's where we are. And it is important to understand that context because it has been a running problem for the last 35 years more. Because in a way, the SEC feels this global market must be regulated by them under their standards and not by these lax European standards, essentially. And that's why we've got this compromise in the form of Regulation S securities and Rule 144A securities. Okay, any, yeah.
So if you're willing to wait 40 days, you don't actually need Rule 144A to resell to investors?
No, you can hang around for 40 days, but who does? You need to sell those securities on issue date, not 40 days later. Okay, now let's move on because there are a couple of other things which need to be understood. First of all, Rule 144A also has a couple more requirements with regard to not just who can you sell to, but on what basis can you sell? Well, 144A D4 requires information to be supplied, which is current, concerning the issuer of the securities. And that has to be made available to qualified institutional buyers to whom the securities are going to be sold. And that involves including financial information about the issuer for 2 years, both the balance sheet and the profit and loss account, okay, for 2 years. Now that suggests that all you have to do is produce a balance sheet and a report on accounts and a few bits of information to be handed over to qualified institutional buyers. But that's not how it works in practice. In practice, this requirement under 144A D4 has been transformed into the production of an offering circular or prospectus. Not a complying prospectus, but one which has got a huge amount of information contained in it. And essentially what happens is one takes the prospectus which has been used for listing in Frankfurt or London or Tokyo, wherever it is, cut and paste, and you've got a thick document of equal size being distributed to qualified institutional buyers in the US. And that's the actual market practice. So you really got now two prospectuses, one going out to non-US investors and the other, let's not call it a prospectus, an information memorandum, an offering circular, whatever you like to call it, containing more or less the same information, and distributed into the hands of qualified institutional buyers for purposes of 144A(d)(4). Now, that raises another problem. Rule 10b-5 of the Securities Exchange Act 1934. That imposes liability for A, material misstatements or material omissions in information which is distributed into the hands of US investors. That's Rule 10b-5. But on top of Rule 10b-5, there's also Section 17A of the Securities Act 1933. But for our purposes, in practice, what is most important is the detailed rule of 10b-5, which says you can't make material omissions in your provision of information, you can't make misstatements, and your conduct in relation to that information must not be misleading or deceptive. So it's quite a wide formulation. Rule 10b-5 has also been expanded by the SEC. That's why it's so important, that it's not just a regulation contained in the Securities Exchange Act of 1934. It's been fleshed out as to what is necessary in order to avoid liability by the SEC. So, what do you have to do about it in practice? Answer is that in practice, a US law firm is always engaged, and I don't mean somebody in the back streets of Arkansas. I mean a top Wall Street firm is usually engaged to do what is known as US due diligence. The same kind of process of question and answer, reviewing documentation and so on, to ensure that all of the information contained in the 144A offering circular is absolutely complete, one, and two, no misleading statements. And at the end of which, the US law firm will issue what is known in the market as a Rule 10b-5 letter. It says, we've done the due diligence which is applicable to an issue of this type, and we say that all information that should be disclosed to investors in the US is contained in this offering circular. That's the Rule 10b-5 letter. It's not a guarantee that you won't be sued by some US investment institution, but it is a tremendously strong protection against such actions or claims being made by US investors. Yeah? I'm sorry?
How can a US counsel find something didn't check, like which was checked?
Oh, no, they do. Oh, they do.
No, I mean like some things that you just don't understand the language, like Chinese. So they have the Chinese.
Yes, you certainly will. If it's in China or in Japan or in Thailand where they're not familiar with the language, yes, they will use counsel, local counsel, and they work with them.
So will they make it like a carve out of that?
No, not at all. They will take the responsibility, because as far as the US regulator is concerned, what the SEC wants is not an opinion of a foreign lawyer, but a US law firm under Rule 10b-5.
Do they then require the local counsel to make it similar?
Well, they will work with local counsel to do the legal due diligence, and then with local counsel's help produce the Rule 10b-5 letter at the end of the due diligence process.
Does the local counsel also need to make like something similar to include the similar?
Well, they won't. What they will do is to give that letter to the US law firm in terms of the way the practice works. Because obviously there's a lot of liability if you get it wrong. US law firm sued, guess what happens? US law firm turns around and sues local law firm. So one is very careful about how it is. And you're back to that same point I made some months ago, about this circle of reliable law firms, which the markets, the US global law firms and the UK global law firms use for these securities. And they are the magic list of these firms. Everybody's got them, and generally speaking, those are the law firms that one would use. You will not use what one might call a backstreet law firm. Absolutely not. You're running too much of a risk. So you want to work in this stuff out there, well, go find out which firm in Kazakhstan is actually doing this work. And I'm not going to tell you. Okay, moving on. Just to round up, before I move on from Rule 144A, just a reminder. We talked about Rule 144A requiring a resale. We talked about how that requirement is satisfied by a Section 4.2 sale complying with Regulation D requirements, followed by a second sale into the hands of qualified institutional buyers, right? That's the legal structure. But I think you need to remember that for practical purposes, the way it works is that the 144A subscription agreement results in a sale, principal to principal, issuer to managing underwriters, followed by a second sale, managing underwriters to qualified institutional buyers. That's the format in which it would work. But in reality, what would happen is the securities will reach the hands of qualified institutional buyers, yes, through the managing underwriters, but directly into their hands, essentially. So technically 2 sales, but in practice just 1. Okay. Other aspects of U.S. securities laws. Regulation M. Reg M regulates stabilization under the Securities Exchange Act 1934, replacing Rule 10b-6, Rule 10b-7, and Rule 10b-8 of the SEC. Now, importantly, Regulation M does not apply to a securities offering outside the U.S. complying with Regulation S. So long as, importantly, so long as all of the relevant stabilization occurs outside the U.S. And 2, that the non-U.S. offshore stabilization complies with stabilization rules recognized by the SEC. The stabilization rules recognized by the SEC for Regulation M purposes are the UK stabilization rules. You know as well as I do, the UK stabilization rules are the EU stabilization rules under the market abuse regulation. Consequently, compliance with the stabilization requirements of the market abuse regulation of the EU constitutes compliance with UK stabilization regulations and therefore complies with Regulation M requirements in the US. That's the hierarchy of conditions that need to be complied with. Yeah, so in effect, if you comply with the stabilization requirements of MAR, the market abuse regulation of the EU, you're okay with US stabilization under Regulation M. Okay, those are details, not worry about it. Okay, we're done on US regulatory law. We've done EU directives and regulations, so we've done the regulatory bit of the module. So what are you going to do now? Hang on, you got questions, okay. Yeah.
Regarding the Rule 144A, there was this limit that it can only be traded between QIBs. Is that throughout the life of the tranche, or is it also restricted to 40 days or anything?
Run that again slowly.
You know how after the Rule 144A,
Rule 144A, yeah.
you're only allowed to trade to other QIBs through that portal on NASDAQ.
Yeah, only because there's a restriction on resales by the first qualified institutional buyer to a 1-year holding period, unless that qualified institutional buyer, the first one, is reselling to other qualified institutional buyers. That's why you need to be within portal. So what's your question?
So my question is, maybe you just answered it. So that restriction, is that only for 1 year that you can sell to other QIBs, or is it forever?
Well, after 1 year, that restriction is lifted, because then you can sell to anybody after that. But the important thing is, if I'm a qualified institutional buyer and I buy a security from another qualified institutional buyer, I get hit with the 1-year restriction. And I cannot sell to anybody other than a qualified institutional buyer. It's that legal framework which produces the whole business of the portal system, enabling sales and resales of 144A securities without worrying about the 1-year hold period. Does that make sense?
1 year refresh every time it gets traded? Does it refresh and start from new?
Everybody gets hit with the 1-year restriction. Yeah.
Sure, the 1-year restriction is just for equity securities, but for bond it's just for equities.
No. That's the Regulation S rule. Don't mix up the two. The 144A requirements are different from the Regulation S rules. The 1-year restriction is to be found in United States securities laws under Section 4.2, and that 1-year restriction goes into Rule 144A, which lifts the 1-year restriction provided resales are to other qualified institutional buyers. You with me? Okay. Hang on, I'm looking for something, but anything else that you want to? Yeah.
Sorry, just to clarify, so if the QIB must hold the bond for 1 whole year before they can sell to a non.
That's the rule. They must hold for 1 year and not sell, unless they're selling to another qualified institutional buyer.
So once the 1 year is lapsed, then they can sell to whoever.
I mean, if they want to, they can sell to whoever. Yeah. Right, any other questions or thoughts? I'm looking for what am I going to do next? So I got another hour to finish off. I was hoping to do, I'm not sure where the slides are, but let me just find it and see. Get on to, what is this one here? Is this somewhere here? No, it's not there. I didn't deal in detail with UK regulation because the position with regard to UK regulation is now virtually, not entirely, virtually entirely covered by EU regulation. The only thing that still survives, even post the market abuse regulation, is Section 397 FISMA, and I didn't mention it because it deals with a criminal offense of market abuse. So if there's conduct which creates a false or misleading impression about the value or market or in securities, that constitutes a breach of Section 397 FISMA. And 397 FISMA is extraterritorial in its application, meaning that if any conduct occurs outside the UK, but an effect is felt within the UK, or conduct occurs in the UK which is deceptive or manipulative in relation to the value of market in securities, 397 creates a criminal offense. Exception to Section 397 market manipulation criminal prohibition is compliance with stabilization rules. You're back through 397 back into MAR. You need to comply with stabilization rules contained in MAR if you want to avoid not just a breach of MAR, but also breach of UK criminal sanctions. So I just thought I'd mention, I didn't deal with it in any big detail because really the operational item now is the market abuse regulation of the EU, so I didn't really go through it in detail. I can't remember, I can't find what I'm looking for on my slide list. That's why I'm rummaging around here. Nope. Project finance, nope. Securitization, derivatives, equity derivatives, convertibles. Christ. Let me see where this is on my other slide. I thought I was going to talk you through medium-term note programs, but I can't find my slide. Let me see whether I can find it on my other memory stick. found. What I wanted to talk about in some detail today was a variation on international bonds. Three types of issues. One, what I call high-yield bonds. Two, medium-term notes, which I've been referring to as I've been talking about bonds. And commercial paper. All I'm going to do is to walk you through what they are, what's the documentation. Remember that the regulatory aspects in relation to high-yield bonds, medium-term note programs, and commercial paper is exactly the same set of rules that we've looked at up to now with regard to international bonds. Okay? But let's start with high-yield bonds. How many of you have heard of a guy called Michael Milliken? You have.
He was the junk bond expert.
He was the junk bond king of the investment bank Drexel Burnham Lambert, which unfortunately went into liquidation due to his brilliant activities. But we don't call them junk bonds anymore. They're called high-yield bonds. The reason being, as the name says it all, these are bonds paying extremely high interest rates when compared with normal standard international bonds of the same currency and of the same maturity. Now, who issues them? Answer is corporates with less than a top-end Moody's or Standard & Poor's rating. Or, and this is even more, probably more the case, emerging market issuers, where there is political risk in that market. High-yield bonds are also used in other contexts. Takeover offers. One corporate entity trying to make an offer to the shareholders of another corporate entity, or to buy out, or a management buyout being effected, you would use high-yield bonds to raise finance very quickly. What is key about high-yield bonds is that they're issued on a subordinated basis, i.e. they're subordinated to the rights of other unsecured senior bondholders. So these are essentially subordinated bonds. That's the first factor. There is a subordination clause saying high-yield bond investors, bondholders, will not be paid before other senior bondholders are paid. That's the first attribute, characteristic. Second, high-yield bonds are subject to a lot more strict covenants when compared with standard international bonds. And I think when we were looking at standard international bonds, I said financial covenants, they don't appear in standard international bonds. But they do appear, once again, the same old covenants that we've talked about in syndicated loans appear in high-yield bonds. In particular, you'll see debt-to-equity ratio covenants. So again, there's nothing new for you, but if you look at the structure of it, you'll definitely see financial ratio covenants, there will be asset disposal covenants, and there will be merger covenants. Similar to those in the SLA, syndicated loan agreement, but somewhat more, well, I should say weaker than those found in SLAs. Usually, the strength of the asset disposal and merger covenants are loosened by a requirement that they will apply only if the issuer's financial ratios fall below a certain level. So, for example, if the debt-to-equity ratio is 2-to-1, the asset disposal and merger covenants might say, if the financial debt-to-equity ratio of the issuer has fallen to 2.5 to 1, i.e. before the breach occurs, of the debt to equity ratio. At that point, an asset disposal and merger covenant contained in the high yield bond is triggered and becomes operational. The next thing that you need to remember is that there are a whole number of covenants which control the corporate actions of the issuer for the protection of high yield bond investors. Now, what they are vary depending on the purpose of the issue. If it's a leveraged buyout, you find one type of covenant. If it's simply an emerging market issuer who cannot access the global markets easily, wanting to pay a much higher rate to have global investors investing in its securities, you'll have a different set of bonds, different set of covenants. But broadly speaking, as a generalization about what you'd expect to see in these different types of high yield bonds, summarize it on the following basis. First of all, there are dividend control covenants. In other words, the issuer can only pay dividends to the holders of the company's shares in specified circumstances. Usually, if the issuer is complying with financial ratio covenants, if its debt to equity ratio is at a certain level, then it will be permitted. If it falls below a level specified, then you will not be permitted to make any kind of dividend payments. Secondly, there are limitations on quite a common corporate activity in the market, namely share buybacks. Companies issue shares if they feel that they would like to increase the value of the shares of the company in the market. They'll try and do a share buyback to push up the company's share price. That's limited in a high yield bond issue. You will not be permitted to repurchase your own stock, your own shares, either during a given period of time or in circumstances where your financial ratios are at a given level. No repurchases. So either a complete prohibition or conditional prohibition on share buybacks. Similarly, there is a restriction on prepaying debt. Not generally debt in the form of syndicated loans or international bonds, but any debt which is subordinate to the high yield bonds themselves. So if you think about it, there's a hierarchy. International bonds, which are the senior bonds, the high yield bonds, which are then subordinated and can only be paid out by the issuer after full payment of the standard non-subordinated senior notes, and then thirdly, the third in the hierarchy are those which are subordinate to the high yield bonds. And the requirement is issuer cannot voluntarily prepay the debt owed to the third group of bond investors, which are subordinated to the high yield notes. The next restriction that's imposed on an issuer of a high yield are investments in subsidiaries. For this purpose, the usual format is for a clause to separate out the issuer's subsidiaries into unrestricted subsidiaries and restricted subsidiaries. It is permitted to invest in those subsidiaries classified as unrestricted subsidiaries, to make any kind of investment in those subsidiaries, or entities which are third-party entities. But it can't make investments in restricted subsidiaries, i.e. they cannot inject cash or capital into the set of corporate entities referred to as restricted subsidiaries. Where would you find this? In an appendix. Restricted subsidiaries, unrestricted subsidiaries. So that is really the guts of the controls that are there in a high yield bond, which you don't see in a standard international bond issue. Now, there are a few further features that you'd expect to see in a high-yield bond issue. First of all, the issuer has a call option, meaning it has a right to redeem the bonds prior to maturity. How that right works depends on the length of the bond, because in most cases, any kind of exercise of the call option resulting in redemption of bonds prior to maturity needs to be financed by an equity issue. In other words, the issuer is required, if it wishes to exercise its call option, to issue shares, raise finance, and use that funding to redeem the bonds that are being bought back by the issuer by way of exercising the call option. You with me or not? No, I thought so. You've forgotten what a call option is. Where have you come across a call option? Sorry? No, not derivatives. I know there are derivatives. But where have we come across it in this class? Sorry? Yeah. It is a technique or methodology of redemption. Absolutely. They are found in standard bond issues sometimes, call options. Issuers' right to redeem the bonds prior to maturity at given times by way of an installment redemption program. We came across that probably last semester. That's probably why it's too long ago. And that call option is found also in high-yield bonds as a general proposition. There's a call option. In standard international bonds, it may be there, it may not be there. In many cases, it isn't. Because if you remember, I made the point that bonds subject to call options are not popular with investors for obvious reasons. Bond trading at 105% of face value, call option kicks in, you lost your bond, and it's redeemed at only 100% of face value. So they're not popular. But in high-yield bonds, they are the standard. There is a call option given to the issuer. But there are restrictions on how much and how it's done. First of all, in a standard issue, taking an example, an 8-year bond, which I've got as an example up here, what you'd expect to see is the call option to be exercised within the early period of the bond, but only up to 35% of the total amount of outstanding bonds. And that must be done by a cash equity issue, which I think is where somebody said, what's all that about? Meaning that if you're exercising this call option within the first 3 years from the date of the issue, that call option means that the issuer will be paying cash to bondholders to redeem the bonds under the call option. The high-yield bond terms and conditions will require that the cash being used by the issuer to redeem these high-yield bonds must be funds which have been raised by the issuer by issuing share capital into the markets. There has to be a correlation, a direct correlation between the amount of cash raised by an equity issue and the amount that is being used to redeem the bonds in the first 3 years of the life of the bond if the call option is being exercised. Secondly, just like in a standard bond issue, if the issue is exercising this call option, it must make a premium payment to the bondholders. It's called a call premium. And the call premium is a percentage of the principal amount of bonds that is being redeemed. It is a percentage related to the total amount being redeemed. Remember that it need not be all of the bonds. It could be 10% of the bonds in the first 3 years, 20% of the bonds in the next 4 years. The issuer has a right to redeem. When you do that, If the issuer exercises that option, it needs to pay a premium to the bond investors calculated by reference to the percentage of bonds that are being redeemed. That premium tapers, meaning nearer to issue date in the life of the bond, early years of the bond, the premium is high. In fact, in some bond issues for the first 3 to 4 years, the issuer seeking to exercise its call option will need to pay double, because the premium required to be paid to a bondholder whose bonds are being redeemed is 100%. Essentially, it's the block redemption in the first 3 to 4 years. Usually, 4 years is the point at which the 100% requirement falls away, and it begins to fall, as I said, tapers as the bond gets nearer to maturity. And it goes down to around 20% as the bond nears maturity, so that if the bonds are being redeemed much later in the life of the bond, the premium payable under the high-yield bond redemption provision under a call option falls to around 20%. Sometimes, yeah.
Do you redeem a percentage of each bond, or like you have an entire pool and you redeem some or not redeem the rest?
No, you redeem a percentage of bonds. Yeah, not. You're thinking about, I think, the structure that you found in serial notes.
Yeah.
It's not a serial note structure. It's a standard redemption structure, which means a certain specified percentage of bonds can be redeemed by the issuer by exercising the call option. Variation of a high-yield bond are margin bonds. These are bonds which are issued to finance purchase of a minority stake in another corporate entity. It's not a takeover, very important. It's simply to purchase a minority shareholding in another corporate entity. What happens in this type of format, where bonds are used to purchase only a minority stake as distinct from a takeover of a corporate entity, is that the bonds are issued subject to the grant of security over the shares purchased in the target company. So shall we say you're going to buy 30% of the shares in a target company by issuing bonds, high-yield bonds. Those bonds will have the security over the shares which you purchase, the issuer purchases in this target company of the 30% of shares in the target company. So it's a security collateral arrangement. But there is a clause which then is operative. Once security over the shares of the target company has been taken for the benefit of the bond investors, the high-yield bond investors, the issuer is required to maintain, under the terms of the bond instrument, a loan-to-value ratio, meaning that the value of the assets needs to have, assets meaning the shares now purchased and are subject to security interest, need to have a certain ratio relationship between the value, the face value of the bonds that have been issued to purchase those shares. That's the loan-to-value ratio, the LTV. Now that means that the only way you can operate that is that there has to be a requirement that the shares must be valued every day on a mark-to-market basis. Those of you who do derivatives will know what I'm talking about when I say valuation on a mark-to-market basis. That is to say, the shares will need to be valued by entities specified in the bond instrument, usually market makers in those shares in the markets, and a value ascribed by reference to the valuation given by those market makers in the shares. Hang on. Do you know what market makers are? I'm using terminology and I've sort of assumed without thinking that you might even understand that word. And nobody said, nah, don't know. Everybody just battered on. Yeah. Now you tell me. This is what happens at lectures. Unless you are on the ball listening and you think, what's that word he used? What the hell is he talking about? You need to ask, okay? In relation to every major corporate entity whose shares are traded on an exchange, and we're not talking about private company, we're talking about publicly listed corporate entities. The share trading involves not only dealers, but people called, sorry, not people, dealers called market makers, i.e. they are the ones who will have a stock of those shares on their books at any time. Therefore, their trading volume is much greater in those shares than anybody else. That's why they are called market makers, because they make the market in those securities. You want a valuation of a share, the best person to go to is one of those market makers. And thus, the standard requirement is, in order to calculate the loan-to-value ratio, the requirement is that quotes be obtained from market makers in relation to the shares which have been purchased by the issue of bonds and is subject to a security interest for the benefit of bondholders. Those of you who were there at yesterday's lecture on equity derivatives, see the parallel? Exactly the same structure is being used in equity derivatives in relation to margin shares. Okay, that was yesterday. Okay, forget about it. Okay, so that's all that you need to know about these things called high-yield bonds, which are otherwise issued, traded exactly the same way as standard bonds. Next, I want to tell you something about medium-term note programs. First thing to remember is they're called medium-term notes, but they're simply international bonds. Why are they called medium-term notes? Well, because 25 years ago, that's in the age of the dinosaurs, bonds were issued for periods of time which were regarded as medium-term, roughly anything above 5 years and anything under 10, 5 to 10 year range. They were called notes because they weren't really bonds, because bonds went for 20 years, 15 years. So they were called medium-term notes. But as the market progressed, medium-term notes are issued for 20 years, 25 years, 30 years. So the significance of the term of the note has fallen away, and they are issued exactly like bonds, and therefore there is really not much difference. I shouldn't say not much difference, because there are differences in the way they are issued, but as a bond instrument, there is none. So what is the difference? Why am I talking about this? Because the medium-term note structure is a different method of issuing bonds to what we've talked about. To date, we've been talking about a single tranche of bonds being issued into the markets. I shouldn't say single, usually it's two tranches, 144A and Regulation S. But it's one single collection of bonds which are being issued. If the issuer wants to issue another set, it's got to go through the whole rigmarole again in 6 months' time or 1 year's time, all over again. Administrative costs, expenses, and all that. The medium-term note program structure overcomes this problem. The purpose of the MTN structure is to enable an issuer to issue bonds on a continuous basis, on the basis of documentation which is referred to as shelf program documentation. The shelf program documentation means that there is, as the name implies, there's a framework set of documents, and bonds are issued under that framework or umbrella documentation on a periodic basis whenever the issuer wants to issue bonds under this framework or umbrella documentation. To that extent, they are the most popular structure as far as many regular issuers are concerned. Is there any difference between standard bonds and these, apart from the shelf structure, apart from the program framework structure? Well, yes and no. If under the medium-term note program structure, the framework structure, the bonds are to be, the notes, medium-term notes, MTNs or bonds, doesn't matter what you call them, are to be underwritten. There is no difference between a medium-term note program, which is underwritten by a group of underwriters, subject to a subscription agreement, agreement between managers, etc., and a normal standard bond issue, which is underwritten by a group of investment banks. But the second category of MTN issue is a different one. It's not underwritten. Key point. Underwritten issues have the same bond issue documentation that we've talked about. Each tranche that's issued under the framework agreement is subject to subscription agreements, agreement between managers, prospectuses, and the like. The non-underwritten issue, however, is a very different animal. The documentation is different. Because here, investment banks will agree to sell medium-term notes, MTNs or bonds, call it what you like, under the framework program agreement, which sets out the standard terms and conditions. But this time, on a best efforts basis, we'll sell what we can. We're not guaranteeing that by closing date, all of your bonds will be sold into the hands of investors. It's a best efforts structure. And in practice, most MTN programs fall within this category, namely best efforts non-underwritten. So you've got a program framework agreement setting out the standard terms and conditions, and a group of investment banks agree that they will sell the bonds of the issuer on a best efforts basis. If they're not sold by closing date, well, that's the issuer's problem. There's no underwriting obligation undertaken by the investment banks. Remind you again, all of the regulations that we've talked about to date are applicable to both types of issues of MTNs, whether underwritten or non-underwritten. In a non-underwritten structure, the documentation is as follows. The most important one is called the program agreement, which is entered into by essentially a leading investment bank or dealer and the issuer, setting out the parameters under which bonds may be issued, MTNs could be issued. That contains the usual conditions precedent, and don't ask me for those again, because this is about the 5th time I'm talking about conditions precedent. The usual representation and warranties, and what is the dealer's obligation answer to sell into the market subject to complying with all applicable regulations. It will also contain a specification of the amount of bonds that can be sold in relation to each tranche of bonds issued under the program. So in other words, the issuer says, well, okay, I might ask you to sell up to 500 million, no more. And the dealer will agree to that amount. And it will also specify whether there's going to be maximum amounts for the notes, what kind of currencies, what kind of maturities these medium-term notes will have. So a program agreement could easily provide euros only or euros and dollars only. Or it could have a specification of a maturity period saying we will not agree to sell notes which have a maturity period over 10 years. So there's a specification of what kind of currencies the dealer is prepared to sell the bonds in, the kind of maturities that the dealer is prepared to sell the notes for, and the minimum or the maximum amounts of each issue. I mean, there has to be a minimum amount because you can't have an issuer turning up and saying, could you please sell me $2 million worth of medium-term notes? I mean, it's a no deal. And therefore, there's a minimum specification. Each tranche shall constitute not less than 200 million or 250 million in value, and a maximum amount for each tranche, saying each tranche shall not be above 1 billion, just to give you some figures to work with. So that's the program agreement, which literally sets out the parameters in respect of the various ongoing tranches of bonds which will be issued on an ongoing basis. Now, when a tranche is to be issued, the additional details that are not in the program agreement will be added in a second document called a pricing supplement. So program agreement and then a pricing supplement, which contains the details of the notes, the interest rates payable, and so on. It will specify essentially the details relating to the bonds which are to be issued in this particular tranche of medium-term notes which are going to be issued under the program agreement. The program agreement enables, therefore, the issue on an ongoing basis. Question, now what happens to the requirements of the prospectus directive, requiring the publication of a prospectus in relation to every issue of securities in the markets in the Union, or indeed outside? Well, the straight answer is Section 5, Article 5, Section 4 of the EU Prospectus Directive provides for the approval of something called a base or shelf prospectus, containing information about the issuer, its corporate structure, its business strategy, its profit and loss, blah, blah, blah. That shelf prospectus is approved just like an ordinary prospectus in the ordinary way. However, that shelf prospectus can be updated with supplements. Unlike in the case of a standard international bond prospectus, which is issued in relation to a particular tranche, and if there's another tranche, another prospectus needs to be produced. This one, same prospectus, but with supplements, what are called updates under Article 5.4 of the EU Prospectus Directive. Now, in practice, MTN programs are always subject to a collective action clause and a fiscal agency agreement. Rarely is a trust deed used, but yes, they are sometimes used. But generally what you'd expect to see is a fiscal agency agreement with the standard collective action clauses in relation to voting rights, calling of default, and all that kind of stuff. Then you've got to think about the bonds themselves. After all, bonds are being issued tranche by tranche in different currencies for different maturities with different interest rates. Consequently, for each tranche that's issued, a fresh permanent global note must be issued. Same program agreement, but each tranche that's issued under the program agreement will have a separate, different permanent global note representing the securities and the currency that they are issued in, the maturity for which they are issued, and so on, and the interest rate which is applicable. The terms of the bond, however, are pretty much the same as in a standard bond issue. No difference in doing that. And that's about all that you need to know about medium-term note programs. Is there a question?
Do you ever have definitives with ATM?
Straight answer, no. There's no reason why you shouldn't if you wanted it, but this, yeah, exactly. It's the modern format of a permanent global bond is far more prevalent. I mean, ask me, I haven't seen an MTN program with definitives in there. Yeah.
Why would an issuer choose a medium-term note program?
Flexibility. One word, flexibility, and cost. Well, you set up the program agreement. You can continue issuing notes under that program with one single pricing supplement and an update in relation to the prospectus. But far more importantly, the cost is low because there are no underwriting fees to be paid. I mean, of course, as I said earlier, you can, under a medium-term note program, have an underwritten issue with subscription agreements and the full shebang of underwriting. But if there is an underwriting commitment given by a group of investment banks, then you might as well do a standard bond issue because your costs are going to be the same as a standard international bond issue. The absence of the underwriting obligation, the underwriting promise given by an investment bank, reduces the costs massively. Yeah?
The NTM program, so then usually it starts specified an end date, so you
I'm sorry?
for the program, is it usually like we're doing a program for 20 years?
Absolutely, you can have it for whatever period of time you want.
Can we have it like rolled over?
You can certainly have an indefinite framework agreement. There's nothing to stop you from doing it that way. Right, last item. Anybody else wants any questions to be raised, discussed? No, okay. Final variation on the theme of different types of notes issued in the markets are commercial paper programs. These are extremely short-dated notes, short-term debt securities which are issued. And this time, the lifetime of the notes is 45 to 60 days in practice, sometimes 90 days. They are a funding mechanism, a short-term funding mechanism, which enables, in particular, banks and financial institutions to raise finance quickly and for a short period of time. That's the rationale for a commercial paper program. In practice, there also is the bonds in an MTN program, as I said, are similar to standard bonds. The currencies, the maturities, the amounts, etc. But in commercial paper issues, the commercial paper is issued in very large denomination. I'd say a minimum of €100,000 in these markets. Sometimes going up to $500,000 per note, not per issue. So if you want to buy it, you're going to have to come up with a minimum 100,000 investment per investor, or $500,000 in some cases per note which is purchased. The commercial paper of this type is also issued under a program agreement, just like an MTN program. No underwriting, it's simply a program agreement which says we will issue commercial paper to be issued by you with a maturity of XYZ in the following currencies with the following interest rates. And the denominations that we require you to issue them in is 200,000 euros or whatever the number is, or dollars. And that's basically the format that is exactly the same as the framework agreement that you would see in an MTN program, which we talked about a few minutes ago. The issue is through not an underwriting syndicate, but through a single dealer or a group of dealers, sometimes assembled ad hoc. No underwriting, remember, therefore it's much easier. The sale is on a best efforts basis. Importantly, unlike in an MTN program, there is no prospectus, not even a shelf prospectus. How can you do that? Well, because of an exemption to be found in Article 3.2 for issues in large denominations. No prospectus is required. And that's why, as a regulatory matter, as distinct from an investment matter, the basic or average amounts of the face value of commercial paper notes would be a minimum 100,000, because that's the minimum set out in Article 3.2 of the EU Prospectus Directive. Okay, second thing you need to remember, I mentioned the program agreement. It's pretty much the same as an MTN program agreement, which sets out usual reps, warranties, conditions precedent, the usual stuff, the currencies in which the commercial paper may be issued, the maximum amount, the minimum amount of each issue, just like in an MTN program agreement. Nothing new there. Here comes the difference, a big one. Because there's no prospectus, because of the exemption from the EU prospectus directive, there is no prospectus. There's a short information memorandum produced in relation to the commercial paper. In many cases, there isn't even a commercial paper. Sorry, there isn't even a prospectus. I mean, if you're having a Deutsche Bank issue, nobody wants to see a prospectus. It's Deutsche Bank, full stop. Just the name on the paper is good enough. Or BNP Paribas, or Nomura, or whoever the major bank that's engaged in this. Commercial paper, once again, is issued by reference to notes which are only to be found in pro forma in the appendix to the program agreement. Once issued, it's, I should say always this time, represented by a permanent global note for the period of time for which they are issued. Given how short they are, 45 days, 60 days, and an absolute max of 90 days, 3 months in other words, lifetime. Never is a definitive printed to represent these commercial paper issues. They're always done on a permanent global note. There is also another agreement which is used, a paying agency agreement, which is pretty similar to paying agency agreements in any kind of bond issue, namely setting out where and who is going to receive payments, which is going to be transmitted back into the clearance systems for distribution to investors. So, important points listed, and not listed anywhere. Remember, an MTN program will have a prospectus, will be approved by a regulatory authority, and will comply with the requirements contained in the prospectus regulation of the EU. Therefore, they will be listed on a stock exchange, approved by a regulatory authority. Commercial paper is never listed. It's an unlisted issue of securities, and it's never underwritten. The transaction procedure is extremely informal, because once the program agreement is in place, an issuer will ring up a dealer, or a dealer will ring up the issuer and say, hi, do you want to issue some commercial paper tomorrow? If the answer is yes, they agree the amounts, and the commercial paper is issued within 24 hours to 48 hours if that's what the issuer wants. And once again, issued in electronic form, represented by a global note for the period of time during which the securities are going to be available. Once again, commercial paper is also subject to Regulation S and Rule 144A safe harbors. You need to sell complying with Regulation S for US securities law purposes, and you need to comply with the requirements of 144A if you want to sell into the hands of any US institutional investor. Same rules. In the EU, however, there's a different regime, because the prospectus directive exemption applies because of the high face value of the commercial paper notes, namely minimum 100,000 euros, no prospectus required. So it works on the basis of no prospectus. And that's basically it, and I've got 5 minutes to spare. Questions? The three variations, I forgot to tell you that I'm going to get on to something far more meaty and substantial next when you come back after your reading break from St. Moritz. But I'm going to get on to convertible bonds and bonds with equity warrants, which are a much more meaty structure that you expect to see. I did this today because I knew that if I started convertibles, I wouldn't finish it today, and you'll go away to St. Moritz or the Cosa movie and come back thinking, what's a bond? So I thought I'd give you something which you can easily digest on the ski slopes. Yeah.
Just to clarify, for commercial papers, they're not done through clearance systems.
They're not done.
Not done through clearance systems like ETC or just issuer and dealer.
The issuer, sorry, the issuer sells through the dealer. I think what you're asking me is a slightly different question. Where do these securities end up? Electronically answer back into Clearstream, you're clear. Same old system. The same with MTNs. The notes end up in electronic form with the clearance systems, with once again the only people being able to buy account holders in the clearance systems. Yeah.
Does the U.S. tax regulation also apply to securities?
Fortunately, no. And I didn't take you through the TEFRA regulations, which do not apply to short-term commercial paper. Because otherwise, you'll have a lockup for 40 days, and the commercial paper has a lifespan of less than 40 days. So yes, there's an exemption. I'm glad you raised that. Anything else? Or can we call it a day and you go up and do your... I tell you what, don't do a lot of reading, at least in Law of International Finance. I'm sure you've got a heck of a lot of reading to do in other modules. For this, if you want to sort of get on top of things, for goodness sake, for those of you who haven't done written analyses, just do those you haven't done, sit together. This time you can use a Facebook group and discuss it with your friends and see how you fare. That's your best reading that you can do. Okay, and I'll see you back in a week's time. Not a week, hang on, in 2 weeks' time. Yeah, oh, sorry, there's an announcement you want to make.
Yeah, about my email and name.
Okay, please go ahead. Announcement from Pathway Secretary.
So, who of you wants to get to this project finance group?
Working.
Please send me an email. I will try to write my email here if there's...
Actually, out of curiosity, how many of you would like to attend the project finance workshops? Oh, great, because that means it is around the 100 mark. No, that's good. Good. What are you looking for?
No, I said I would write
Sorry?
my email.
What are you trying to do?
To open, to write here. Yeah.
Can you?
Yeah.
Okay, wait. Let me just...
No, not yours. It's okay.
Okay, I will shut this down. Okay.
Oh, please stay a minute.
Just say bottle of wine arriving.
I will write my email here. So if you stay, I will just...
And I just repeat my bottle. I was wondering what the hell you were taking photographs of. You guys don't even write anymore.
A deadline, we should say deadline to them as well?
I'm sorry?
Deadline for sending
Yes,
it,
yes, please. Hopefully by the end of February. Done? Thank you.
Well, is there anything?
This is all.
Yeah.
I'm leaving that with you.
Yeah, what I will...
Are you coming to those project finance class or you're not
Yeah.
interested?
No, I'm...
You are?
Yeah, just...
I mean, I would like to have done full module,
Yeah.
I mean half module, but I just can't be done because there's no one to mark the exam papers, and that's can't be done. That's why it's just workshops and nothing else.
Yeah, I would love to attend.
Yeah?
Yeah,
Okay, good,
I will
good.
include
Turn your name
myself
down
in
to
the
the
list. Yeah, if you have any questions about the list, I updated these people and I
Okay.
moved only the people that were necessary. Like that were written from you. I don't know anything about if there something.
Sorry, the updated list, one
Yeah,
they gave me.
yeah.
Yeah, okay, fine,
Yeah.
thank you.
Is there anything that may...
Okay, thank you so much. Hi.
I'm the representative of the Postgraduate Law Society.
Sorry, which society?
Postgraduate Law Society.
Okay.
And we organize the June Ball. the 3rd
A
of
ball,
June.
oh, right, the usual
Yeah.
annual June.
Yeah.
Okay.
And we would like to invite you.
Oh, thank you very much.
Yeah, I sent you an email.
When, today?
No, it was last week.
Sorry,
I can resend it.
could you?
Yeah.
That would be
There
great.
are all the details.
Where are you having it this time?
Hilton. It's like
Oh,
the last
excellent.
time.
I mean,
Yeah.
I was going to say, because sometimes people go and have it in some crazy, bloody, useless places like pubs, and you think, come on.
No. It's
Hilton
proper.
is
It's
good.
proper bowl. Proper
A
bowl.
proper bowl.
Yeah,
That's
yeah.
fantastic.
So basically, you can confirm that.
Long dress and bow tie. That's good.
Yeah.
Okay, thank you very
Yeah.
much. Appreciate it.
Yeah. Thank you.
June, roughly, when is it?
Third.
Okay, even
Yeah.
better. Okay, good. Okay, thanks a lot.